Let me now shortly introduce Gonzalo Gassos. I hope this was right. Gonzalo is the Senior Director of Prudential Policy and Supervision at the EBF, and he is leading the department in charge of risk management, supervision practices, crisis management, and economic analysis and reporting. He is a member of the EBS Management Committee, Secretary of the Banking Supervision Committee, and a member of the Advisory Board of the European Banking Institute. Further, Gonzalo coordinates the EBF prudential policy in Brussels and the relationship with the SSM in Frankfurt. Gonzalo worked for Santander and for Accenture before he joined the EBF. So Gonzalo, then over to you.
Thank you for your introduction, Andrea. Good afternoon, everyone. Thanks also for the organization to Pascal and to my colleagues Paco Martinez and Ricardo Sanchez from Bankinter for making the link between the EBF and the European Confederation of Institutes of Internal Audit that meet today in this event. It is also very interesting for me to speak in front of this virtual audience because it's the first time we have the opportunity, at least myself, to get in contact with the internal audit function at the European level after the 12 years I've been working here at the EBF. I must say I know about internal audit because, as Andrea mentioned, I work in a bank, Santander, where the internal audit function in the old days, and I suppose it continues being a very, very strong function that we call the second line of defense when it came to supervision. And supervision, as you know, in the last 20 years has become increasingly important in the daily life of banks. And I will speak about that in the context of COVID during my presentation. Let me first introduce briefly the European Banking Federation is the representation of European banks in Europe. We have about 5,000 members, which are all the private banks, some savings banks, and cooperative banks as well. We have an office in Brussels and another office that we opened in Frankfurt for relationship with the single supervisory mechanism from its constitution in 2014. Our members span across the European Union, the European Economic Area, and also the UK, whichever format of association it takes going forward, and also including the accession countries to the EU and the countries that are in the farther east of the European geography, which are also quite important for us in terms of geopolitical interests. So we will talk today about what is the effect of the COVID crisis on regulation and supervision and what can we expect going forward. But to me, what is after COVID means after March 2020. That is after COVID. COVID was just one single effect that took place in the mid of March 2020. And from then on, there was a very quick reaction by banks, by stakeholders, by European authorities that I will summarize. And if we look backwards, in terms of regulation, every crisis is a real-life test. As memory says, the great financial crisis was a test of the previous framework, which had a lot of benefits in terms of Basel II. I can only speak very well about the well-conceived framework of Basel II. However, we learned that it was too short in terms of quantity of capital and too poor in terms of quality of that capital and loss absorbency. We also learned that liquidity that was followed by national competent authorities on a voluntary basis had to be harmonized across Europe and followed in the Basel Committee as a global standard. and many other lessons were learned in that crisis. 5 years later, in the euro area crisis, we also spotted the problem of the sovereign bank link that was addressed with a strong and quick reaction to put up the banking union that we are still implementing in its second and third pillar. So the COVID crisis, what are the lessons learned? If we reflect on what has happened right after COVID, we have to be quite positive, not complacent, but quite positive about the regulatory framework we had in place when the crisis hit. If anything, it was a bit too rigid, but it took banks with the highest capital ratio in the last decade, and since we can remember. That gave reassurance that there wouldn't be a systemic crisis following the hit of this crisis. It also reinforced the success of the European system of financial supervisors that was conceived in the Larosière report, which to me is really the game changer and the most influential source of thought and practical implementation in Europe. We talk a lot about Basel, which is the background of the standards, but the Larosière report envisages the structure of European supervisors that has let us withstand this crisis. And the policy reaction, as you can see in that slide, had for the first time in Europe, had the characteristic of being well coordinated, and strong and quick with all the authorities combined with monetary policy, but that wasn't enough. There was an important injection of money, both in TLTRO programs, but also with the Commission and the Next Generation program. That wouldn't be enough. Money itself can be useful in the short time, but it's not enough. There was also an important regulatory and supervisory reaction that accompanied those very large economic programs. And I would like to refer to those which are probably subject of the daily work of internal auditors in terms of regulation. What happened? Right after the outbreak of COVID, we engaged with the European Banking Authority to put in place a moratoria to avoid that a lot of clients that didn't have any payment bad record in the past would be trapped in the vicious circle of being marked as default in the middle of an economic crisis. So that was put in place by the European Banking Authority. You have all the data about the numbers of those who benefited from this program that has come to an end on 30 September 2021 after 2 postponements. That gave us a lot of time, but there were also importantly transitional arrangements of IFRS 9 that were given the possibility of banks to extend them to a longer period and not the initially one envisaged during normal times. Importantly, of the many measures, I would highlight that the regulators anticipated the use of additional Tier 1 and Tier 2 to count as capital to meet the Pillar 2 requirement. That was important. Also, the encouragement of the supervisors to use the buffers in those times. However, I must say here that our regulatory framework has also these MDAs, the mandatory distribution amounts, which are hardwired in the regulation level 1 and are a very important limitation to the capacity that the chief financial officers of banks have to take a decision to reduce the buffers and come closer to the minimum requirement, which would put at risk the possibility of the bank restricting the distributions not only of dividends, but also of coupons of subordinated debt that has already been used to meet the MREL requirements. There were also many other measures that were carefully examined, like reduction of the prudent valuation adjustment, which was an overly conservative measure put in place after the crisis, the reduced market risk multipliers, the SME supporting factor was also brought forward, and the infrastructure supporting factor that was agreed in the last edition of the banking regulation in Europe. So all this battery of actions meant that banks could withstand the crisis without reducing dramatically in a short time their capital ratios. We estimated that impact in about, in the next slide we'll show it, in about 200 basis points of core equity tier 1 capital ratio, which, if we consider the whole European banking sector, would mean around 250 billion capital that wouldn't be lost for regulatory purposes. And this would mean about 4 trillion euro in terms of lending that could still be held up by banks with the same capital. However, some of these measures were just temporary and have come to an end, and others were anticipation of regulations that had already been agreed the year before. So in the next slide, I will show what is happening right now. So that was the policy reaction during the last 18 months. Now, if we put ourselves in November 2021, we look at the situation in terms of the non-performing loans, which is the major indicator of credit deterioration. And nobody would expect the situation we are living now. It was unthinkable only 12 months ago that the NPL ratio continues declining in the European banking system, and it's now, according to latest figures, at 2.5%, which is the lowest value in the last decade. Should we be optimistic about this? We think we have to be also careful, because other hidden indicator, stage 2, is increasing from an average of 6 to 7%. We have seen it has jumped to 10% some months ago, and arguably it could reach now 12 or 13% according to estimates of the European Central Bank. So if only 30 or 40% of those stage 2 loans came to default in the next 2 years, it would be a big amount that, however, banks would be able to absorb, because the creation of provisions has been huge, as you see also in that graph, especially in December 2020, in anticipation of a potential peak of NPLs that has not materialized. Banks created a lot of provisions in the form of overlays, and now we have an over-provisioned banking sector according to the real situation, waiting for the NPLs of COVID to materialize. The end of the moratoria can perhaps put some pressure in the materialization of those NPLs in the next quarters. We can move to next slide, please. And yes, I wanted to also reflect with you about the type of NPLs that we will see sometime soon, maybe in 2022, perhaps in 2023. In the past, we are used to dealing with legacy NPLs that came from real estate bubbles, from euro area crisis. These were mostly rotten loans that had been sticking to the balance sheet of banks for too long. And the main way of of working out those NPLs was by realizing the collateral and forcing NPL sales, most of them via asset management companies. What we will face in the next months is potentially a lot of unlikely to pay cases. And this is a completely different type of loan and type of situation and type of client. Many of them might be businesses who have been paying their debts for long years with no delay until COVID hit their businesses or the sectors. So there is more sensitivity on the one hand, but on the other hand, there is more need for a tailor-made assessment, bank by bank, loan by loan, of those situations in corporates, medium-sized corporates, and especially SMEs. This is happening now in banks, as you know better than me. This is the situation, and we'll need to walk this new stage of NPLs, probably with a different set of tools than the ones that we had in the past. Moving to other topics we will face in the coming months. In the next slide, we talk about climate change risk, and of course this is a new priority that has pervaded all the actions we take in banks. On the one hand, we know that especially the largest banks, but the whole banking system has created units for the following and monitoring of climate change risk in the last years. And we think that from the publication of the ECB top-down stress test results last month, that could be the kickoff of a new stage where actions will be taken at the prudential and supervisory level. As you know, the European Central Bank has created a climate change center that will start driving the strategy of the ECB in terms of supervision together with the SSM. This comes also with a high political pressure and a very strong commitment of the European Union to lead the way. Therefore, it will have implications. It will have implications in the bank clients. It is more, and we insist that it is a general economic issue that will affect corporates, and banks as intermediaries of those corporates could face some financial risk. I show in that slide some numbers about the impact that policy reaction on climate change could have on banks very soon. More than 20% of total exposures of banks could be subject to physical risk, which is a lot, a very important part of the loan book. And 35% of economically relevant climate losses are estimated to be insured. So there is another 2/3 of that part of exposures that has no insurance. We'll need to take decisions in all banks about all these new threats. I'm sorry that my voice is coming slowly. It's reminding me that I'm still recovering from a cough. So I will streamline, if you don't mind, Andrea, and then take some questions. We have another slide showing some interesting facts about climate change. Next slide, please. We like to distinguish how banks can be affected and what is the effect on companies. We think, sorry, this is very important to distinguish, not to mix up banks with the economic objectives and the impact on the corporates that could be subject to transition risk at different paces. This will become even more important now that the banking package has been published, as you know, last week, in principle to transpose Basel III, but also it includes a very important section on ESG risk that is already being assessed by the Council and the Parliament, and will bring us to concrete decisions. At the European Banking Federation, we think that the regulatory framework and the prudential standards should not be used to channel political mandates or policy on climate change. Of course, there is a transition risk that will translate into financial risk. And financial risk need to be covered, but no more than that. So just to finalize my presentation and start the Q&A, if you want, in the last slide, I might show what is coming and the main activities that will keep us busy in terms of regulation in the next 2 years. The end of moratoria is already a reality. We were asking the European Banking Federation for a soft landing. The fact that the NPL ratio is still very low has not put pressure to take other measures. That is fine. However, there is one we still have in mind after long conversations with all stakeholders, including chief risk officers, including consumer protection agencies, including the European Commission. There is a threshold that limits the capacity of banks to deal with viable clients that could be able to generate resources again after a certain period of time when they overcome the problems of COVID-19. And that is the 1% net present value that limits any sort of forbearance measure that a bank could take or could be negotiating now with those clients. If that limit is slightly enhanced under control on a temporary basis, it could save a lot of those viable clients without incurring in financial stability risk. Then we will have the postponement and revision of Basel III. Obviously, that's the elephant in the room. The banking package that includes many other issues, including fair country branches, supervisory powers, restriction to dividends, and so on. The NPL action plan launched by the Commission will also take center stage, especially when the NPL reverts its current declining trend and goes up again. Climate change is in the top of the agenda. The bottom-up stress test will start next year with the ECB. And in the background, we will always have the completion of the banking union, a very, very long-term project we never forget about. So with that and with the pictures of the main actors of our European authorities on slide, Andrea, I would put an end here to my presentation. I'd be happy to take questions and engage with you. Over to you, Andrea.
Well, first of all, thank you a lot that you had this presentation, although you do not feel so well. So thanks again for that, and also for giving us some insight into the EBS view on post-corona, as you put it, in the post-corona world and actions. So we are now happy to take questions, but I would suggest, in order to not to stretch your voice too much, we limit that to 3 questions, if any. So I see a first one now. Do you believe that the new business model of banks should influence the internal audit work?
I'm a firm believer that internal audit is a very important function in the bank, and I know that from my experience. Now you need to translate that into different types of banks. In my experience, I have been working in large banks where there are sufficient resources and economies of scale are also important. In smaller banks, it's more difficult to have a well-resourced internal audit function. But again, banks face new challenges, and I think internal audit should always be seen as an intermediate step to supervision. I think what we need to work together with the supervisor is to make the supervisory task lighter, thanks to the intervention of reliable internal audit units.
Could you be a little bit more specific on the last point, because I think it's very interesting what you just said last. Your last point.
Yes, I can expand a little bit more on that comment. Since we experienced the SSM supervision has been really an improvement in terms of Europeanization of the banking system. It has been consolidated, what is a success that wasn't taken for granted at the beginning. It was difficult, but it's consolidated. However, it's also true that it comes with a big effort and sacrifice by banks and with a lot of dedication to supervisory tasks. To the extent that internal audit can facilitate the work of supervisors and potentially slightly reduce the time that the business functions of the bank dedicate to supervision, that could be a good experience. And I think it is an opportunity going forward now that the European supervisor is consolidated.
Yeah, I think we would all agree to that. And also agree to your very strong call for a strong Europe, so to say, and the benefits of the SFM and more harmonization of the banking sectors across European countries. For the time being, I do not see any more slides or any more questions on Slido. Uma? Well, then I would say, Gonzalo, thank you very much for your time once more and that you took part in our forum, although you do not feel too well. And I would say we come to the next agenda point. Thanks. Thanks again.
Very much hope to see you in person and in good condition next time.
Yeah, thank you.
Bye, Andrea.
Goodbye.